What happens when the government stops backing flood insurance and leaves millions of homeowners to face the private market alone? The flood insurance gold rush. Is the private market ready for the deep end? The National Flood Insurance Program, NFIP, is on shaky ground. Again, politicians are arguing, budgets are tight. And whispered in the halls of Washington is a word that strikes fear into some homeowners and excitement into some boardrooms: privatization. For decades, the government has backed the risk of living near water. But if they step back, who steps up? The private insurance industry. It sounds like a massive business opportunity. Millions of policies up for grabs. Billions in premiums. A whole new market. But is this a gold mine or a landmine? The new calculations of risk. Private insurers don't play by government rules. They don't have voters to worry about. They have shareholders. The NFIP has historically used broad flood maps, sometimes outdated, often subsidizing high-risk homes with tax dollars. Private insurers? They use tech, satellite data, granular property-specific modeling. They know if your backyard slopes 3 inches toward the creek. They call it full-risk pricing. Sounds efficient, right? It is, but efficiency costs money. If the private market takes over, they won't offer the neighborly discount Uncle Sam provides. They will charge what the risk is actually worth. And according to data from Insurify, that math is brutal. We aren't talking about a few extra bucks. We're talking about a 64% average hike. That's $600 more a year for the typical homeowner. With the government-backed flood insurance program, NFIP, facing an uncertain future. Would you be willing to pay significantly more for flood insurance from a private company if it meant more accurate risk assessment? Or do you believe flood protection should remain a subsidized government program to keep it affordable for everyone? Share your thoughts in the comments below. Would you pay more for private coverage, or do you prefer a government-subsidized program? Going from a manageable $934 to a painful $1,534. Matt Coleman, Chief Risk Officer at Demex and a climate risk expert, explains that accurate pricing relies on good data. Numerous private and public data sets exist and are used to create sophisticated geospatial models of precipitation and flood risk, he says. These models both broaden and deepen an insurer's perspective of the frequency and severity of flood-linked perils. Coleman emphasizes that insurers have been pricing natural perils for decades, using trusted data and modeling to form a view of risk and charge premiums that compensate them for warehousing that risk. The Gulf Coast gamble. Let's look at where the water actually hits the land. The Gulf Coast. This is the belly of the beast for flood risk. Florida, Texas, and Louisiana hold the majority of NFIP policies. Florida alone has nearly 2 million policies, about 38% of the national total. Is the private market ready to absorb that much risk? Imagine a bad hurricane season. Not just one storm, 3 or 4. The NFIP can borrow from the U.S. Treasury when it goes billions into debt, and it has. Before we continue, stay up to date on all the latest insurance news, expert tips, and breaking developments by subscribing to our YouTube channel. Your support helps us deliver the stories that matter most to you, with clear explanations and timely updates. Just click the link in our bio and hit subscribe to join our growing community, so you never miss an important update in the world of insurance. A private company, they can go bankrupt. If private insurers take the wheel in Florida, premiums are projected to jump 76%. The average cost would leap from roughly $900 to nearly $1,600. In Louisiana, even worse, an 87% spike. Private insurers might cherry-pick the safest homes, the ones on high ground with new roofs. But who insures the older bungalow in New Orleans? If the NFIP vanishes, those homeowners become radioactive to the private market. Uninsurable. Coleman acknowledges this challenge, noting that private insurers are likely to participate in a market if they can charge sufficient premiums to protect the insured and remain profitable over time. However, he warns that if insurers cannot collect enough risk premium, government participation may still be necessary. He points to the Indian agricultural sector as an example, where government subsidies enabled private insurers to offer protection while retaining enough premium to remain viable. The inland surprise. It's not just the beach. Here's the twist. The biggest percentage price hikes aren't on the coast. They're inland, We forget about river flooding, flash floods in valleys, but the private market hasn't forgotten. Their algorithms see it all. Take West Virginia. It's not famous for hurricanes, but its steep terrain and narrow valleys are a nightmare for flash flooding. Currently, West Virginians pay a high premium, around $1,678. Under a private full-risk model, that could skyrocket to $4,633. That's a 176% increase. Pennsylvania faces similar risks: heavy rains, overflowing rivers. The overlooked crisis of inland flooding becomes a financial crisis the moment subsidies disappear. Private insurers see these unique vulnerabilities: steep slopes, poor drainage, and they price them aggressively. Coleman, who has a background in meteorology and pricing weather derivatives, believes private market modeling is sophisticated enough to price these complex inland risks. Accurate pricing relies on good data, he reiterates. The availability of trusted data and modeling of natural perils, verified alongside observed loss experience, allows insurers to form a view of risk and charge an appropriate premium. The billion-dollar question. So, can the private sector actually do this? This isn't a new question. We've been asking it since 1968. That's when the NFIP was created because private insurers refused to cover flood risk. It was unprofitable, too volatile. Has that changed? Sort of. Technology is better. Reinsurance markets, where insurance companies buy their own insurance, are stronger. There is an appetite for flood risk now that we can model it down to the inch. Coleman sees this appetite as genuine, particularly when flood risks are incorporated into a diversified portfolio. To the extent that reinsuring U.S. flood exhibits a non-correlating, diversifying underwriting opportunity to reinsurers, and that reinsurers are able to charge an appropriate risk premium, then there should be the appetite to underwrite flood risk, he explains. He adds that if a risk capacity provider can assemble a diversified portfolio of sufficiently priced risks, it can scale its business across time and space. But there's a catch. A purely private market works for the wealthy. It works for low-risk homes. It does not work for the working-class family in a flood zone. The solution, historically proposed, isn't a cold turkey switch to privatization. It's a hybrid. A mix. Private insurers take the good risk, and the government acts as the insurer of last resort for the bad risk. But even that leaves a gap. If private insurers skim the cream off the top, the NFIP is left with only the riskiest properties, a death spiral of debt. The bottom line. The private market is smart, agile, ready to write policies, but they are ready to write them at the real price. Are we ready to pay it? For the industry, it's a chance to innovate, to use data to drive smarter building decisions. For consumers, specifically in places like Hawaii, facing a potential 218% hike, it's a warning. The safety net is fraying. If it snaps, you better hope you have a very good calculator and a lot of savings. Let's recap the key takeaways. If the NFIP steps back and private insurers take over, homeowners face an average 64% premium increase, from $934 to $1,534 annually. The Gulf Coast bears the heaviest burden, with Florida facing a 76% hike and Louisiana an 87% spike. But inland states like West Virginia could see premiums jump 176%. Private insurers use sophisticated modeling and full-risk pricing, which means accurate assessment, but higher costs for high-risk properties. The solution may require a hybrid approach, private insurers handling low-risk properties while government remains the insurer of last resort. But this creates its own challenges. Thank you for watching. Stay informed, stay prepared, and make sure you understand the real cost of the risks you're taking on.